Welcome to the Capital News. I'm your host, Alex Kreitis. Today is Monday, March 29th, 2021. Thank you so much for joining me. Hope you all enjoyed your weekend. The title of today's podcast, Margin Calls in Fragile Markets. I believe we are at or nearing the precipice of the end of this magical bull market run. Something to me just does not feel right at all. Of course, I've had these feelings for a while, but the fragility that exists within these markets is unavoidable. Now, of course, if you listen to a lot of the quote-unquote experts and analysts on the mainstream financial media, they'll continue to argue that everything is fine, the fundamentals are solid, that the stock market is well-balanced, etc., etc. I would just like for some of the financial media to push back on some of their guests and say, you really think that the stock market is really fundamentally sound? So you're saying then we could remove all of the liquidity that the Federal Reserve and other central banks have thrown into the system and everything will be A-OK. Clearly it wouldn't be. Clearly equity markets couldn't stand. Clearly, bond markets couldn't stand if you just pulled out all of the liquidity that was thrown into the system over the past year, year and a half. Yet somehow these people come on, they march on these various platforms, these various news stations, and they say, yeah, everything's perfectly fine. Some of them just argue that this is the beginning of another bull market run. And they just don't ever seem to give the credit where the credit is due. Just say that this is all because of central bank policy. I would have so much more respect for people if they would do that. But then if they do that, they might be putting their jobs in jeopardy, because then the question comes down, well, what are you doing then? What type of analysis are you really conducting? Do you really have to conduct any type of analysis? Because if stocks only go up and this is turning into a perpetual money-making machine, then why do we have all of this infrastructure of all of these quote-unquote analysts, all of these skyscrapers, all of these office buildings, all of this technology and software and hardware all over the place? What are you doing? Why do we need you people? Why do we need the middlemen and women to write reports and do research and this, that, or the other? Stocks only go up. What is your purpose? It's turning into a perpetual money-making machine. These are not markets. This is a casino, and it's crazy. And investors of all caliber are becoming, if they are not already, punch drunk. And the title of today's podcast, again, is Margin Calls in Fragile Markets, because those of you who may have been paying attention to some of the news, we have a family office that is in quite some trouble. And we're going to get to that, a brief article out of CNBC. This is another shot across the bow, I think. Now, I think the bigger shots across the bow, as I believe economic history will prove out over time when we look back on this era of the everything bubble, of the central banker's paradise, of this fiscal insanity, I think the fourth quarter of 2018 is going to be noted very well. I think the third quarter of 2019 is going to be noted very well, because these were periods in time where markets were starting to break down. Now, in the first of these two examples here, in the fourth quarter of 2018, it was readily apparent what was going on. The Federal Reserve was announcing that they were going to taper their balance sheet. They were going to reduce the size of their balance sheet. This was announced well in advance. This was talked about. This was the central bank doing a lot of hand-holding for Wall Street and investors. This is the plan. We've been embarking on this quantitative easing experiment for a decade. It's time to start taking away the drugs. It's time to start removing the punch bowl. It's time to take away the crutches. You can stand up on your own and you can walk. And depending on what politician was in your face at the time, they were telling you this was the greatest economy ever. So, well, then we definitely don't need the crutches. And it's not, well, you're ready to stand up, you're ready to take baby steps. No, according to some, we were ready for the 100-meter dash. But as soon as we started to remove those crutches, the markets collapsed 20% in the fourth quarter. As the federal funds rate inched up just little by little, month by month, meeting by meeting. And that was it. That says to me, and what I think the economic historians are going to show in due time, is that the experiment of quantitative easing was a complete and utter failure. It does not work, it did not work, and it will not work. What it will do, though, is it will create bigger gaps in wealth and income inequality, which is exactly what we're seeing, which is just stirring the pot for a breakdown, which we're already in the midst of our economy, of our body politic, and of our broader society. Because all of these things are connected. You push on one, pull on the other, there's going to be interactions, there's going to be counter forces. There's going to be ripple effects. There's no escaping this. So you couldn't take away the punch bowl after doing this for a decade, because the president then threw a hissy fit, because the markets couldn't take it. Couldn't take a 10-year note yielding 3 1/3%. Couldn't take it. Couldn't take a federal funds rate at 2.4%. Yet with a $19-20 trillion economy by GDP, you would think we could sustain those things, but couldn't do it. Then you fast forward to the third quarter of 2019, and you had the repo crisis, which nobody, as far as I'm concerned, with all of the research that I have done, you can take that for what it's worth, I have not come across anybody who's been able to say definitively what took place during the third quarter. I think really starting specifically September, October. I think more in September of 2019 with the repo crisis. The overnight lending facilities that banks go through, okay? And hedge funds are involved in this. So I wouldn't be surprised if something happened behind the scenes where the Federal Reserve stepped in. We know that they stepped in. But the question is, were they bailing some institutions out in the process? And they very well could have been. Because that's also going to be part of our discussion when we get to this CNBC article, because the bailouts never stop. And they're likely, obviously, going to continue. So, despite banks making record profits on their trading desks, even in the midst of this pandemic, because of the implicit and explicit guarantees that one central bank after the next has put into the system, they've just announced it. This is what we're going to do. You're not going to lose. So go ahead and make these bets. Go ahead and make these trades. Do what you got to do, because you're not going to lose. We will backstop you. Yet even with all of that guarantee, even with all of those bailouts, greed gets the best of them and nobody bats 1,000. So it was just a matter of time before something like this, with this family office hitting a wall, making a mistake. And you start to see the interconnectedness of all of this nonsense. And nobody has a full grasp of these types of trades and what goes on between a hedge fund, a family office, other banks, etc., especially when you're adding and piling on leverage upon leverage upon leverage. And it puts the whole system at risk. And when they do this, and when they fail, they're the ones that get bailed out. This can no longer stand, but this is the system. And it is only going to get worse. So the fragility in these markets, to me, is so clear, it is so evident. And the problem, of course, is because it's so fragile, it could be anything that knocks it off of its perch. And despite this, you had the Russell 2000, the small cap index, sell off big. You had the NASDAQ sell off. Not huge, not like the Russell 2000, but it got dinged today. The S&P was down but relatively flat, and the Dow, of course, continued to buck the trend and closed at a new all-time high. So there is somewhat of a breakdown across these major averages, and sometimes, historically speaking, that is part of perhaps a topping process. This is somewhat reminiscent of the dot-com era, where what leads up leads down. And of course, then it was the NASDAQ, basically the same case here with the tech sector. And the NASDAQ has been selling off more aggressively than has the S&P 500, which was the case during 2000. So this could be a topping process, or maybe this is just a period of a correction and consolidation. And perhaps the yo-yos that come on the mainstream media and say this is just the start of a bull market, maybe they're right, because maybe these markets will continue to buy what the Federal Reserve and other central banks are continuing to sell. And again, that is the only narrative that matters at the end of the day. Not whether it's the weather or power outages or even geopolitical risks or what the federal government here or anywhere else is going to do from a fiscal standpoint policy. It's all noise. The only thing that matters is, will the markets continue to buy the narrative that more liquidity continues to flood the system, and so go prices for equities and bonds. And they just keep going up. That's all that matters. Once the market says enough is enough, that's it. There's nothing they can do, no matter how hard they try. And they will try very hard when that day comes. And I think they're getting concerned that it's nearing. I really do. Because you have to pay attention not just to their rhetoric, but you have to pay attention to what they're doing. And we have been seeing a huge number of central bankers come out day after day. Sometimes multiple central bankers on the same day coming out in attempts to calm the markets. Even though the markets are still near all-time highs, or as I just noted, the Dow just hit an all-time high, as did the DAX, the German markets. So what's the concern here? Why is everybody so antsy if everything is great, if all of the fundamentals are right, if this is just the beginning of another bull market, if all of the reopenings are going well, if the vaccines are working effectively, then what's the problem? Why are central bankers, one after the next, coming out to say everything's fine? Well, if everything's fine, you don't have to come out and say everything's fine. Everybody would know everything is fine. This is akin to somebody who is always telling you, I'm a trustworthy person, I'm an honest guy. If somebody has to tell you that they are trustworthy or honest, they're probably not trustworthy or honest. Just saying. And we know the track record of central banks. Ben Bernanke and company saying, well, there's no subprime crisis, there's no housing crisis. And even if there is, it will be contained. No, wrong, and wrong again. And now they tell us there's no inflation. So that kind of tells us that there is inflation, and it's not going to be transitory or temporary, that it's something that's going to be here for quite a while, I believe. But a lot of the markets continue to believe their narrative, that it's just going to be transitory, that we don't have to worry about it. And I think the markets are going to be in for a rude awakening, because I don't think the markets are accurately pricing in the real threat and cost of the inflation that lies ahead, nor do I think that they are fully pricing in the geopolitical risks that I think are very evident, but they don't get a lot of play in the American media. They just don't. I mean, a lot of the articles that I read to this audience, they're not American. They're European or Middle Eastern or Asian. The American people don't know what's going on. What's important here in this country is that Dr. Seuss is a racist. Mr. Potato Head is no longer a mister. That's what's important. What are the royals doing? That's what you have to pay attention to in this country. You understand why there's problems? So I'll get to that article here shortly. Something else that we have been mentioning for the past several months is that the Democrats in particular, but Congress in general, is just getting started. So we had the $1.9 trillion piece of crap, we have the $3 trillion infrastructure and, some other little pet projects thrown into the mix because, it's very easy to hide something in a bill that is $3 trillion, okay? So they're throwing in some pet projects in there. And now we learn that there's likely going to be some other type of stimulus package. So I would imagine that's probably going to be some other check that's going out to the people. We've also learned that there is an extension, a few-month extension for the eviction moratoriums, I think through the end of June. And we are starting to witness some pushback from the court system. And I would imagine the reason is because the landlords, these property owners, guess what, folks? They have rights. And does the federal government have the authority to simply say, well, you can't kick people out? Well, then how are these landlords and these property owners going to continue to make these mortgage payments when they are they were previously being able to make those mortgage payments because they had people renting their building, renting their home, paying rent? Well, what an idea. And now you don't have to pay rent and you can't get kicked out. You can't get kicked out, So, well, I'm just not going to pay rent. Maybe I'll pay 50%, maybe I'll pay 80%, maybe I just won't pay anything at all. Don't have a job, I'm not going to pay you. And there's nothing you can do about it. So this is going to get ugly. And they have been able to push this, now, for almost 18 months. This is what happens. This is the authority figure telling you what to do. People buy it for a while. This is what happens when you have trillion-dollar deficits and you spend trillions of dollars above and beyond what you already have. It will buy you some time. But the end of the road is nearing. And what's going to happen when all of these people get kicked out? What do you think is going to happen politically? What do you think is going to happen economically? What do you think is going to happen from a society standpoint? What do you think is going to take place in the streets? So these idiots are just getting warmed up. Okay? And you can't obviously ask these people any serious questions because, the hyena, the vice president, she's going to laugh because that's what she does. And the president, he doesn't know where he is. So good luck getting a straight answer. You're going to get, I don't know. You're going to have to refer that to somebody else. And the other one's just going to laugh at you because she doesn't know where she is either. So welcome to the United States of America. That's the best we could do. That is the best we can do. Obviously, we're talking last week about the Suez Canal traffic jam. Well, fortunately, the Ever Given, the ship that was stuck in the canal, has been removed, and that congestion is being relieved. Almost 1 full week being stuck, and of course, blame it on the weather. It was high winds and a sandstorm. Again, I am not pretending to be an expert on these ships, but I have a very hard time believing that was the cause for this ship being stuck. I do not believe in coincidences, and with all of the geopolitical risks that exist, I just think this was a setup for something that is likely coming down the pike. I don't know what that is. This is not a conspiratorial podcast, so I'm going to leave it at that. But I do not believe in coincidences, and the wind moving this ship and grounding this ship for a week, I am not buying it. So we will see what happens. So market performance here, we have the dollar index trading at 92.93. 92.93 on the dollar index. Little change right now in the overnight trading session. This is hitting a few month high back to November levels where we have been for the past week. So this could continue to put some negative pressure on emerging markets if this upward trend in the dollar continues. The overnight session, the biggest gains against the dollar, however, are in the Australian dollar, gaining 0.2%, and then the New Zealand Kiwi gaining about 0.3% against the dollar. And Bitcoin is currently trading at $57,000 a coin. Overnight futures trading, the Dow Jones and the S&P 500 are both flat. The NASDAQ 100 is in the red, about 0.2%. The Japanese cash trade is currently in the red, just down about 0.1%. A mixed bag across the pond in Europe today, but again, as I stated earlier, the German exchange is hitting an all-time high despite the back and forth of lockdowns, shutdowns, opening up, back and forth, what have you. Australian cash trade gave back 0.7%, and Chinese stocks are up about 0.6%. On the commodity front, WTI is at $61.53, Brent at $64.92 a barrel, natural gas $2.65. Gold and silver both got hit today pretty bad. Gold is at $1,707 an ounce. Silver is at $24.60 an ounce, and both are down about 0.3% in the overnight session. And copper is currently at $4.05 a pound. And Uncle Sam's 10-year junk note is yielding 1.74%. So basically a new recent high, taking us back to levels we have not seen since last January. So if we continue to see a strengthening dollar and rising yields, the narrative, if it is to remain true, is that this is going to put continued downward pressure on stocks, especially the tech sector. So you will see some outsized losses, perhaps, in the NASDAQ or with respect to some single tech stocks. We'll see if that continues. It may not. We'll see what continues with the Russell 2000. Of course, that was extremely overextended on a technical standpoint and most likely a fundamental standpoint as well, because don't forget, about a quarter of the Russell 3000, so even broader, the Russell 3000, about a quarter, 25% nearly, of those corporations are classified as zombies. So to see the basically miraculous run-up that we witnessed from the fourth quarter through part of the first quarter here with respect to the Russell 2000, going back to the Russell 2000, just overheated. You know, this is just a pullback, or maybe it's something more significant. But we will continue to monitor. And of course, we are now hitting basically with the 10-year note at 1.74%. This is basically equaling the S&P 500 dividend. Okay, so if you're basically looking from a risk-adjusted basis or risk-reward basis, well, you could invest your money, you could park your money in Uncle Sam's 10-year note, and you're going to get 1.74%. And we're told that Uncle Sam's debt is risk-free. Well, the S&P 500 isn't risk-free. So would you rather park your money with Uncle Sam? Now, of course, that's the broader S&P 500. Diving into the S&P 500 or the broader markets, you can obviously find some pretty solid companies, because they still do exist, folks. Make no mistake about it, that have some pretty good balance sheets, have a lot of cash, very manageable levels of debt, and they pay a strong dividend. But if this yield continues to climb, then people might start to say, well, it's, from a risk standpoint, I don't need to have that type of exposure in the stock market. Let me go into the debt market. But the scary thing is, of course, is one of the biggest bubbles that exists is within the bond market. I mean, that's what quantitative easing is. So everything is distorted. That's why these markets are so fragile, and I just don't think it's going to take that much to prick this bubble. In fact, we know it's not going to take that much, because we already have a benchmark for this. We already have a shot across the bow in the fourth quarter of 2018 to guide us. And then real quickly, again, before we get to the article out of CNBC, what is taking place in Myanmar is continuing to deteriorate. Armed forces are continuing to shoot and kill their own people. So that is not a good situation at all. Down in Brazil, a couple of President Bolsonaro's chief ministers have resigned. So he is dealing with some political uncertainty of his own, economic weakness. So obviously we talked last week, I believe it was, with the Brazilian central bank increasing interest rates because they are attempting to fight off the inflationary forces that exist in Brazil. And with the increasing cases and deaths from COVID-19, this is just a perfect storm for something to go very, very wrong down in Brazil. And Brazil, of course, is not small potatoes. one of the largest economies on the planet. About $1.9 trillion GDP. Of course, that's what the piece of garbage that we just passed was, $1.9 trillion. Again, just to put things into perspective. But nonetheless, that is a lot of money. That is a big economy. And there are a lot of people in Brazil. So that's something to be mindful of. And of course, we also paid attention to Turkey because President Erdogan of Turkey fired his central bank governor because he dared to increase interest rates in attempts to fight off their runaway inflation. And of course, we witnessed the Turkish lira and their stock market collapse by 9-10% on a single day. So don't tell me that there are not geopolitical risks all over the place. And I just don't think that the markets are paying any attention to it. I just don't think that's the case at all. But onward to this CNBC article. Now, most of the time, as I state, I do a lot of reading because I don't like listening to the talking heads on CNBC, Fox Business, or Bloomberg. I just don't like doing it. So forgive me if I am mispronouncing this. Again, I was just doing a lot of reading today. This is out of CNBC. So the woes that arose from Archegos Capital Management at the end of last week bled into Monday as a slew of big banks saw their share prices decline. Here's how the $20 billion blow-up unfolded. U.S. media stocks ViacomCBS and Discovery experienced severe selling pressure on Friday, with each losing more than 27%. How many times have I stated here over the past months, if not years, that we can see these types of one-day declines in big-name companies? Here it is. A few Chinese internet ADRs, including Baidu, Tencent, and VIP Shop, also suffered sell-offs of a similar magnitude last week. ADRs are American Depository Receipts, essentially a certificate that represents a share of a foreign stock and is traded on American stock exchanges. The culprit for the massive selling was a forced liquidation of positions held by the multi-billion-dollar family office of Archegos. This is according to CNBC. Archegos, founded by former Tiger Management equity analyst Bill Huang, built massive positions in these stocks through swaps, a type of derivative that investors trade over the counter or among themselves without having to disclose the holdings publicly. These swaps usually involve higher than usual leverage. These large leveraged bets came under pressure after ViacomCBS's $3 billion stock offering through Morgan Stanley and JP Morgan earlier in the week fell apart, which triggered broad selling in the name. The initial weakness in ViacomCBS triggered a chain of events where the prime brokers rushed to exit the positions on Archegos' behalf and resulted in a massive margin call. The hedge fund was forced to inject more cash to cover the losses, amassing a forced liquidation of more than $20 billion. And that is not chump change. The sell-off in these names continued on Monday, with ViacomCBS down more than 8%, and Discovery was off by more than 3%. A slew of big banks involved are warning of the fallout from the unwind of certain trades, but are not specifically mentioning Archegos. Nomura, headquartered in Tokyo, issued a trading update on Monday, citing a significant loss at one of its U.S. subsidiaries, resulting from transactions with an unnamed U.S. client. Japan's largest investment bank said it was evaluating the potential extent of the losses, estimated at $2 billion. Its shares fell nearly 14% on Monday alone. Nomura did not immediately return a phone call from CNBC. Credit Suisse said it and a number of other banks it didn't mention were also affected and had begun exiting positions with the unnamed firm. The Zurich-based lender's shares were down more than 15% following the announcement. While at this time it is premature to quantify the exact size of the loss resulting from this exit, it could be highly significant and material to our first quarter results, notwithstanding the positive trends announced in our trading statement earlier this month, end quote, according to Credit Suisse. It added that it would provide a further update on the matter, quote, in due course. Goldman Sachs, Morgan Stanley, and Deutsche Bank also facilitated Archegos' liquidation of its holdings in many of the Chinese internet names through unregistered trades. Deutsche Bank said on Monday that it significantly de-risked its exposure associated with Archegos without incurring any losses. Quote, "We are managing down the immaterial remaining client positions on which we do not expect to incur any loss," end quote, according to Deutsche Bank. Morgan Stanley also avoided significant losses from the trades, and Goldman Sachs didn't immediately reply to CNBC's request for comments. The SEC has been closely watching the impact from Archegos' margin call default. Quote, "We have been monitoring the situation and communicating with market participants since last week," end quote, according to a SEC spokesperson. Well, don't you feel better? The SEC is monitoring the situation. Wonder who they're going to go after. Probably nobody, because that's what they're known for. They're not going to go after these guys, most likely. So we just read off a slew of banks. You understand the interconnectedness of these markets? Just a little bit. And that's all I'm asking the audience to understand, because there's nobody out there that understands the true extent of all of the interconnectedness within our financial and economic markets. It is simply too complex. And all I simply ask is that you are aware of it and that we respect it, because a lot of people aren't aware of it and a lot of people don't respect it. And this is the type of thing that can happen overnight. This is the type of thing that can unravel very quickly. And it can bring down a lot of big firms with it in the process. I mean, when you see double-digit declines in these stocks, and these are not penny stocks. These are not startup companies. These are banks that have been around for generations, some of them for centuries. This is not small potatoes. So you have to respect what is going on here. These dominoes start to fall. That's it. I don't know how they're going to be able to stop it. And do we want them to stop it? That's the other question. That's the other philosophical question that needs to be asked too. Do we want them to stop it? Do we want them to continue to bail out these banks, these financial institutions, these hedge funds, these family offices, etc., etc.? Me, the answer is no. I want these markets to be cleansed. I want the malinvestments to be gone. I want these zombie corporations to be gone, or to liquidate, to restructure, what have you, and come what may. The further we continue to kick this can down the road, the bigger the correction's going to be, and there is no easy solution to all of this. But the quicker we can allow these markets to correct, as damaging and destructive as that is going to be, the quicker we can begin to rebuild on the other side. But that is simply not an option at this time with Janet Yellen, with Jay Powell, with Christine Lagarde, with Joe Biden, even though he doesn't know what the hell is going on, with Kamala Harris. It's not an option. It's not an option. It's not an option with any of the Democrats. It's not an option with any of the Republicans. Nobody wants to take any responsibility, so we're going to continue to see these types of articles, most likely on a pretty frequent basis, of some order. So there you have it, margin calls in fragile markets. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Karitis. Godspeed.